Good morning, listeners. My name is Richard Rawlison. I am the Global Client Champion, and this is your OPC Oil Markets Update. Not necessarily the statistics just now, that can be something separate, but what I wanted to do first of all was introduce who are these organisations, what reports they produce, what information they provide to the market, how they can move markets, and any trading opportunities they can create. So first of all, who are the API and EIA? The API is the American Petroleum Institute. It's one of the largest oil and gas organisations with 600 members in 27 state capitals. The EIA is the Energy Information Administration, who claim a 98% response rate of their surveys distributed to operators. The EIA is released on Wednesdays at 10:30 a.m. Eastern Time, and the API is released Tuesdays at 4:30 Eastern Time. The monthly estimates between these two are said, and I quote, you'll know what's coming now if you've read any of my RR emoji updates on LinkedIn, that these two numbers are within 1% of each other 81% of the time. How very Anchorman. The major difference between the two organisations is the API is voluntary, it's a trade association, whereas the EIA is a governmental agency, so that's mandatory. As we all know, it's been a roller coaster of a year, in oil specifically. We had last year in March the negative settlement of 37.63. We had the Saudi and Russian oil conflict. We had Trump, ex-POTUS, ordering the Energy Secretary to fill the SPR, which is the Strategic Petroleum Reserve, to the tune of 77 million barrels. That's really going to prop up the price. But what actually happened was Congress ended up failing to fund that. And what they did was they rented the space out instead to the likes of Total, or the US arm of Total, Chevron, ExxonMobil, and they put 23 million barrels in there. And all those barrels needed to be removed, let it be known, by the 1st of March, so a couple of days ago. So when we're seeing all these huge crude draws in these API and EIA stats, you know, to Robin Hooders or the less the less experienced investor, should we say, this could look like demand. Sure, you know, there's a crude draw, we are using more than we are producing. It's simple economics. But what we should note is that 16% of this demand is actually been the movement and the agreed removal of this inventory. We've had the change in administration to the Biden administration. We've had stimulus money sent out to millions of Americans who have got nowhere to spend this money. You know, pubs are closed, shops are closed. We've had the Texas freeze, which very quickly took out, and unexpectedly, took out between 3 and 4 million barrels per day from America, which last year, you know, let's say if it produced between 12 and 13 or 11.5 to 13, it's going to be around about a third of American supply. You know, no wonder flat price just went on a tear the last couple of weeks, right? But this time last year, or this time 2 years ago, sorry, we had crude trading 67s. We had last year trading 56s. And in the last 12 months, it's literally gone from 0 to 60. Incredible. Which is actually unfortunately, unlike a lot of the Teslas last week, who, due to the freeze, weren't able to charge their cars. Maybe one for another time, actually, because I saw the World Bank recently. We'll do an electric vehicle versus fossil fuels podcast, maybe. Let us know if you want us to discuss that. And excuse the corona cut, I've just seen it. But we had the EU officials last week urging the World Bank to exclude fossil fuel investments. So interesting times ahead. But anyway, back to the stats, Rich. I think one really important point to note here, and I missed it, hands up. I was speaking to Tom Krul at oilprice.com and Dean Foreman, PhD and Chief Economist of the API, on LinkedIn last week. Again, feel free to search RR Emoji Market News or follow markets.com on all the appropriate platforms. What's happened, and I quote, oil demand was within 1% of its pre-COVID-19 levels, despite and to some extent because of the pandemic. Anyone who needed medical masks, PPE, or anything of the like, ordered online. Literally an Amazon car's just gone past. That's perfect timing. And the essentiality of these materials is what's fueled this global phenomenon, right? So again, what did you last buy online? Mine was through Amazon. And with all these things that need to come through our door after buying online, that takes some form of oil gulping transportation, right? I think also people forget, fruit for breakfast. I think what a lot of people forget is that a lot of household items need oil. Plastics, toothbrushes, contact lenses that I've got in now, a laptop that I'm looking at here to check a few stats, the mobile phone I'm using to record this, the lipstick that I took off before making this podcast, or rubber gloves, crayons, washing machines, garden hoses, a veritable cornucopia of items. And also very apt for right now. Obviously, we have electric cars, their components, tyres and the like. But more so, syringes. Vaccine, right? Syringes. All these things involve oil in their manufacture. Personally, I feel that we're oversupplied globally. I know there's some areas of tightness, and I know some people will strongly disagree who are maybe more in the know than I am. But, I've previously worked in oil. I've previously been an oil broker. I'd like to think I understand the ebbs and flows of the global dynamics, but we've had lots of geopolitical events. We've had lots of environmental events that we discussed. We've had OPEC plus meetings. They created a 2.3 million barrel deficit, said Goldman Sachs last year, by restricting the supply. We've had shut-ins when prices became financially unviable last year. In fact, the API themselves said it was 26 of the last 33 weeks that's been in decline. So we've reduced the SPR now by 153 million barrels. We've had weather freezes. We had storms last year. Remember Motiva Enterprises, the US biggest refinery, that was closed for Tropical Storm Laura. So really, of course, the SPR's declined. Right? There's the rig count. Look at the rig count. That was 620 last year. We're now at 305, 309. One of my colleagues, again, on LinkedIn provides a very good analysis on that. But we've got American unemployment, 6.3%. You have UK unemployment, 5%. We have Eurozone unemployment, 8.3%. So it's tough times out there. So I'm just unsure, again, where this demand's coming from. Is it that removal that we discussed? Or is it because production's been restricted? I remember last year, for a year-on-year comparison here, we had over 1 billion barrels in storage. Distillate stocks were at a 9-year high. US stocks were 25% above the 5-year average. Gasoline had 10 million barrels, stock barrels higher than last year. Yet at one point in January this year, inflation went from 0.5% to 7.4%. So are those cars going back on the road? It looks that way. But, Marco Dunan said it best. He's a greater trader than I'll ever be. He's the chief executive of Mercuria Energy Trading. And he said a while ago, it's a bubble mess. So I tend to agree. I don't think yet we've not found that equilibrium geographically. But again, like trading, right, the beauty of trading is there's opportunity. There's opportunity everywhere. And what you can also do is use the data to completely flip the narrative. Everyone will know I love a line, the data tells the story, but you can also tell, two almost conflicting empirical stories with data. So if we take the other angle, stocks outside the API stood at 1.3 billion on Feb 19th, higher than 1.287 billion at the same point last year. Stocks are less than 1.5% above their 5-year average. Related to 5-year averages, actually, surplus is now, I believe, in the 40th percentile. Last year, they were in the 92 percentile or 92nd percentile. Crude and gasoline stocks are pretty much the same as the 5-year average, and distillate stocks have a small 5% surplus. We then also have, China, who have completely mopped up lately. They've really been in on the buy side of the markets. We have, Singapore windows, European windows. We can see action that goes on there. And they've been filling their own SPR. In fact, talking of windows, it's probably a good time to introduce the Platts dated Brent assessment. So Platts are proposing a change to their premier assessment right now. Dated Brent, or the cash BFOE, which is Brent, Forties, Oseberg, Ekofisk. There's actually another one called Troll as well, which are oil fields in the North Sea that make up the basket that is Brent crude. They will now be including WTI, so West Texas Intermediate, Midland, from July 2022 deliveries. So, we're talking billions in exposure here. Lots of bilateral deals, lots of regulated instruments that this could potentially affect as well. So maybe there'll be some ARB opportunities, who knows. We should probably discuss further down the road as well, OPEC. Can they maintain this production discipline any longer? Russia aren't that well known for their compromising attitude, should we say. Essentially, either way, like whatever your penchant is, be it dated Brent, be it WTI, be it dated Dubai, Urals, less liquid grades like Mars perhaps, this inequality that we're seeing at the moment, or this dislocation between futures and physical, means, you know, markets are going to do what they always have. They're going to create excellent trading opportunities. So I implore you to have a look at and check out markets.com. Feel free to add me on LinkedIn, direct message me, offer me any content suggestions. We're more than happy to help. So thank you very much for listening, and I look forward to hearing your questions next time and seeing you again soon. Have a good day.